welcome to the special edition of The Global View with me, Tanvir Gill. My guest today on the show is Hugh, who's Managing Director Asia at Aberdeen Asset Management, one of the largest foreign investors in the country. Hugh, it's great to have you on the show. Thanks very much for taking out this time. Now, your career spanning 3 decades has seen 3 major crises. The Black Monday crash of 1987, the Asian financial crisis of the late 1990s, and the global recession that hit the world 7-8 years ago. What is your perspective then to the panic sound bites one has been hearing since the start of the year?
Well, in many ways it's very, very different. So the crises that one experienced 10 years ago, 20 years ago, back to 87 were fairly major, certainly for emerging markets. As far as this current crisis is concerned, it's relatively light for emerging markets. And it's obviously an immense issue for developed markets, and we've seen unprecedented economic measures taken as a result. QE, for example, which sadly has proved to be utter madness. But as far as this part of the world, Asia or emerging markets are concerned, it's a slight sideshow, but it's having tremendous consequences. Valuing money at 0 or minus 0 is insane, of course. And it has distorted asset values and the like, which is disturbing for stock markets and other valuations that we see everywhere in the world.
Yeah, and that's the tricky part, Hugh, because, you know, like you pointed out, all this money supply via QE is happening in the developed world. But, you know, we've seen record outflows in emerging markets. Aberdeen has reported about $12.5 billion of net outflows in the first 3 months of 2016, following, you know, nearly $18 billion of withdrawals in Q4 of 2015. Why are investors pulling money out of developing countries? And, you know, what does that really mean for your own approach towards your portfolio? Because you're still largely keeping your portfolio intact. You're keeping your faith with some of the cyclical businesses. You've not gone more defensive despite the pressure that you've seen.
Yes, it doesn't really change our views on individual companies, and ultimately we're investing in a collection of what we think are the world's best or the region's best companies. So our view of what is a good company doesn't really change that often, because it's very hard to make a good company, and hopefully it's also hard to destroy a good company. And we've certainly seen huge flows. We saw huge flows in up until 3 years ago, so many, many billions flowing into our funds. And ever since Ben Bernanke spoke 2 or 3 years ago, we've seen a shift away from emerging markets to developed markets, and in many ways it's been a US dollar play as well. So there's been a substantial currency element behind it. But does that really change the fundamentals? That ultimately over the next 2 or 3 decades, if you pick the right companies, of course, which is a big if, will you see greater growth from the likes of India or China? And that's certainly where the multinationals are going, whether it be a Nestle, Procter & Gamble or whoever. But the distortions we've seen have been tremendous, and I think a lot of that is due to QE. And of course we discover that many investors operate in a herd-like instinct as ever, so they all jump on the same bandwagon at the same time, which is our industry's fault in many ways, and jump off it at the same time as well.
Yeah, but why do you think investors are going risk-averse on emerging markets, given that the QE problem has not solved the growth issues in the developed world?
Well, that's exactly what's confused us. So we don't fully understand why that's happened. Again, a one-way bet on developing or emerging markets has turned into a one-way bet against. But if you look, there are certainly reasons for argument or hope, depending which position you take. that things have turned. So whether the US dollar has turned, that's an argument. Whether valuations in developing markets are now sufficiently attractive to have the money swing back. People traditionally are very reluctant to be the first mover, so they wait for things to happen and then again jump on the bandwagon. There's certainly evidence so far this calendar year that emerging markets are coming back relatively into favour, and that the US dollar is declining in its attraction. Evidence, but it's very early days yet.
Right. But do you believe, Hugh, that the awakening investors world over have, that the QE policy has been the wrong policy for the markets, has compressed expectations on growth, yes, and that's been much debated, but also expectations on earnings, which then trickles down on, trickles down to having lower expectations on returns. So emerging markets, which were averaging between 15 to 20% traditionally, the return expectations have been revised lower to perhaps 10 to 15%. What, in your view, would be a reasonable return expectation from emerging markets in this sort of a low growth environment?
Well, I think expectations of 10 to 15% returns, whilst they might be achievable in stock market terms, certainly from aggregate earnings from emerging markets are under 10%, I'm afraid to say. So we're talking about single-digit earnings growth in the current calendar year. Things are still very quiet. I mean, obviously they're extremes. So we have the energy markets, the Brazils, Russias of this world that are having a tough time, although the bump up in oil prices is short-term helping. We have places like India where the growth is still relatively strong. But of course the thing that's happened and changed over the last 20, 30 years is that the world has become so much more interconnected. So it's very hard to speak in isolation about one country versus the other. Businesses have gone cross-border. Economic influences out of the States or Europe or Japan or wherever affect all markets. Business has gone global, so it's very hard to separate the world as cleanly as we used to 20, 30 years ago when I first started looking at these markets.
Right, Hugh, is your conviction with staying invested in Rio Tinto, largely led by your confidence in the recovery in the commodity cycle? You expect iron ore prices to double from here. Does that mean that, you're betting on a revival in the steel sector, which is a user industry?
The honest answer is not really. I think you're maybe ascribing more cleverness to us than is warranted. We've been investing in Rio for 30 years, simply because it's been a very focused commodity producer of a range of commodities about which we've had no great skill in forecasting over the years. And when we first invested in Rio, it wasn't really for iron ore. But again, the skill of Rio is that it's had these incredible commodity supplies at relatively cheap cost. They've reduced the costs of production year after year. They're in safe, in inverted commas, territories. And ultimately the commodities are commodities that are required by the world. So iron ore is still in very high demand. Yes, the iron ore price gets inflated from time to time and collapses from time to time, as it has done. But Rio is still throwing off billions of dollars worth of cash, even with the iron ore price having collapsed. So we hope the iron ore price will go up, but it's certainly not a strong forecast.
Right, Hugh, I just want to touch upon then the risks that 2016 started off with, which was essentially oil prices, commodity prices, and China. Have those risks, to your mind, settled down?
Oh, that's a million-dollar question. Certainly prices in commodities got so depressed, and when oil got to 30, everyone was saying it was going to 20, which is usually a good guarantee to say it's going in completely the opposite direction, because people are dreadful at forecasting these things. So we perversely got a little more bullish of commodity prices, not for any terribly intellectual reason, but just because they've been so hammered. And at certain prices you will ultimately have production disappear, and demand for things like oil or iron ore is still ultimately increasing. People want more oil, they need to produce more steel. But these things could be highly cyclical, and from our point of view, providing one sticks with the low-cost producer, who even when the price of the commodity collapses by 80%, they're still covering their costs, they can still reinvest in the business fine.
Let's then talk about India, Hugh. And, you know, I remember sometime last year you had said buy India, avoid China. Your EM fund has pretty much an equal allocation to both India and China. Is it more a replacement call, replace more of China with more money into India? How are you looking at the India story?
No, I think two very different instances. In many ways, we'd dearly love more money in China. I mean, it's a large country, it's growing, etc., all the obvious reasons, but we can't find the companies. India is very much a similar story. I mean, it's a big country, it's growing at quite a fast level, with hiccups along the way, as any country will have. The difference with India compared to China is that it has some really world-class companies that are available for investment. So you do have the classic multinationals listed in India, the Unilevers of this world. You have some wonderful homegrown companies, the HDFCs, the pharmaceuticals, some of the IT services companies. So very, very different. And India is more attractive for the equity investor, I think, than China.
But, you know, given that India has seen a big event in the budget being unveiled just last month, has that convinced you to stay on course in India? You know, what is the kind of opinion that you gather on Indian policy making, given that the government has spent 2 years in office so far?
Oh, well, having been sort of investing in India for nigh on 30 years, one's learnt not to rely too much on government. And in many ways, the success of India has been lack of government rather than because of government. The companies in India that have done well have been those where the government has interfered less. And we came in very, like everyone else, hopeful that Mr. Modi would transform things on day one. But the reality of India is such that one man, however well-meaning he is not going to change things. And for the optimists, I think Mr. Modi has proved a slight disappointment. But for people like us who've known India for a long time, I think things have progressed as we expect. So change is happening and the genie is out of the bottle.
Well, let's then talk about your India investments. And as part of your EM fund, as also your India fund, you have a big holding in HDFC. Now, the tricky part there is Goldman Sachs recently came out and put a downgrade on HDFC, citing rising competition causing pricing as well as growth pressures for the company. I mean, it's quite easily understandable that everybody, given the liquidity situation in the market, is getting into the loan business. Is that detrimental for HDFC? Does that get you worried?
Oh, yes. There will always be more competition, which is a concern. And of course, the valuation of HDFC is a concern, but it's a super business. And one day, yes, its margins will be eaten away, others will come into the business, and it will always have to be sharp and on its toes. So far, so good, but we live in fear of all our successful investments in India, as we do everywhere else. Businesses can disappear well, not quite as quickly as they arise, but they can disappear very quickly.
Right, but having held HDFC for the period that you have and gained the returns that the stock has made for your portfolio, would it be a time where you would reconsider kind of stepping back a bit on the investment and looking at other spaces in the financial sector in India? There's a lot of work happening in the PSU bank space and the state-run banks, and valuations are cheap. Is there merit in re-looking at that space and reworking your financial sector investment in India?
Well, we look constantly, and there's certainly a clear temptation if you have HDFC at 3 or 4 times book value or whatever P ratio it's on, up in the 20s, compared to various state banks at a discount to book and single-digit price earnings ratios, if you believe them. But does it tempt us to switch fundamentally out of the quality end into what I would argue is a lower quality end? It's difficult. It's difficult for us. I understand the logic of what you're saying, and it's certainly something we worry about, but over the years we found it best to stick with quality. So would we take a bit of money off HDFC from time to time because it's a bit pricey and there's potential of competition and the state banks getting their act together? Yes. And if we could find equally good companies, again, yes, we would diversify a bit, but fundamentally I think we'll stick with our large holding in HDFC.
Yes, and some of your other holdings are technology companies, TCS and Infosys. You have some of the consumer names, so HUL is part of your holding. But this one caught my attention. Container Corp is a holding. Did you participate in the recent offer for sale? And is that likely to be the theme? Because there's going to be a lot of state-run companies hitting the market. There's talk about state-run insurance companies coming to the market. Is that a space that is exciting you?
Yes, I think anything sort of distancing itself from the state does excite. And the interesting Concor or Container Corporation has been, it's been one of the more professional state-run companies, if you catch the nuances. So we've felt comfortable with that for many, many years, and have held it for 10 or more years within our portfolios as a professionally run state company, still with the concerns we always have in not just India but any country over state ownership and the way state-controlled companies are run and controlled, and whether they're as professional as they should be. Concor is one of those that's been at the most professional end of state-run companies.
Right. Hugh, before we wrap up, just 2 questions very quickly. One on the Indian policy, especially on the monetary policy side, the RBI, there's much pressure on the central bank to cut rates once again. They've given 125 basis points of rate cuts to the economy. How do you as an investor would look at that move and what that means for growth in general, and also how that really trickles down on earnings growth, which have been lagging? I mean, what are your own forecasts, and do you think that that will materially change with another series of rate cuts?
Well, first and foremost, we want the Reserve Bank to remain firmly independent, and it's done a super job so far and hasn't proved totally pliable to political interests. And the big concern we have as far as the Reserve Bank is concerned is the banking sector as a whole. So the recognition of bad debts and bad loans within the banking sector is probably the most negative thing that we think about India. Yes, would we want Mr. Modi to implement reforms? Of course we would, but some of the core things that concern us are the level of bad debt within the banking system, and that really has to be addressed before India can grow again. And it's quite a tightrope the central bank governor is riding in between encouraging growth but also trying to clean up the banking system. So I'm not sure whether interest rates should be reduced radically over a quick period. I think the big issue is to sort out bad debt and enable good lending to occur. You just need to look at Mr. Mallya, for example, to see how much bad lending has occurred in India, and that's rife, which is appalling.
Oh, yes, indeed. That case has pretty much laid precedence on what should not be done and avoided when it comes to loan making in India. My final question to you, Hugh, is about broadly the market valuations at these levels at 14, 15 times 1 year forward. Does India make for a compelling case to buy, to allocate more, to increase your overall weightage to the region? If you're looking at, earnings growth coming between 8 to 10% for FY16, and we're going to close out the year very soon, and then perhaps in FY17 trending between 12 to 15%, and I'm talking in rupee terms, is that, relatively encouraging enough to increase investments in the region?
Superficially, yes. I think when you look at the detail, you'll find that the really good companies in India, if you like, the HDFCs, the Unilevers of this world, are trading at substantially higher PE multiples. And then you have the state sector that's trading at a very low PE multiple. So it's very much a barbell. And would you be paying the prices for the quality with total comfort? I think not. I think the overall economic story is super. India has so much potential. Mind you, we've been saying this for a decade or more. But I think it is unstoppable. But then if you look at the quality within India, it's fairly highly priced at the moment. So as far as we're concerned, we just ride with it. So we ride with the quality, and it's a matter of luck or judgment maybe, whether you switch from quality to cheap, lower quality in the hope that it might get better. But I think that's a very brave decision to switch all your money out of an HDFC Unilever into state-run banks or the equivalent.
Well, Hugh, thanks very much for taking out the time to speak with us. Really appreciate your views as always.
Thank you.
There you have it. One of the key foreign investors in the country saying, yes, they are still betting on the India growth story. India looks relatively better than other emerging markets. But when it comes to India, they rather stay invested in quality paper, especially in the sectors where they see more earnings visibility. Some of the largest holdings in Aberdeen Asset Management from an India perspective include some of the major IT companies like TCS and Infosys, HDFC, as we spoke at length about, as also some of the top-grade consumer companies such as HUL. With that, we come to the end of this edition, the special edition of The Global View. Thanks very much for watching.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.